Welcome back to the deep dive. It is Tuesday, January 20th, 2026. And today we are looking at something that has arguably pulled off the single greatest rebranding exercise in financial history. We are talking about stablecoins.
It really is a rebranding, isn't it? Yeah, a complete identity shift.
It is. If you just rewind 3 or 4 years, stablecoins were the wild chips of the crypto casino. They were volatile, they were risky.
Controversial. People were terrified of them.
But here we are in 2026, and they have become the absolute boring, essential plumbing of the global financial system.
And in finance, boring is the highest compliment you can possibly get. Boring means it works.
Yeah.
Boring means it's reliable. It means you can build an economy on top of it and not worry if the pipes are leaking.
Exactly. But boring doesn't mean simple. And to understand how we got here and, what it means for the money in your pocket, we have a serious stack of research today. We're looking at the latest fintech analysis from Panagiotis Kriaris.
Which gives us a great lay of the land.
Yeah, and we have this really heavy technical paper on risk mitigation models. It proposes a fascinating new way to structure this money.
That paper is a heavy read, I won't lie, but the hybrid model it proposes is it's a game changer for how we think about digital cash.
It is, and we'll break that down. We also have an autopsy of the Terra Luna crash from way back in 2022.
The bad old days.
Just to remind us, and some fresh data from Tokeny on where the yield is actually going, because that is the big question, right? Where's the money?
Yield wars. I mean, that's been the story of the last 18 months. Who gets paid?
So here's the mission for this deep dive. We're going to explain how the Wild West was tamed by the Genius Act. We'll dig into why the biggest banks are just terrified of stablecoins paying you interest.
And then connect it all back.
And connect the dots to see what this has to do with your Apple Card and, those AI shopping assistants that are starting to pop up everywhere.
It's the story of digital money finally growing up.
So let's start with the rules of the road. Because if you look at the landscape today, in early 2026, it feels so different from just a couple of years ago. The regulatory fog has lifted.
Completely. The turning point was 2025. You had two massive milestones that essentially paved the driveway we're on today. First, back in April 2025, the SEC finally dropped the hammer.
Or the gavel.
The gavel, right. They gave a clear ruling. Fully backed, one-to-one redeemable stablecoins are not securities.
Which was the sword of Damocles hanging over the industry for, 5 years?
It was paralyzing innovation. But the ruling came with a huge catch. The SEC said, okay, these are payment instruments.
Not investments.
Not investments.
Yeah.
So they cannot offer yield. You can't treat them like a contract where you expect a profit.
So I can hold a digital dollar, it's safe, but it's not going to pay me 5% interest like a savings account.
Precisely. They severed the payment utility from the investment return. And that set the stage for the big one, the Genius Act, signed in July 2025. This was the U.S. government making a strategic pivot.
Away from a CBDC, everyone thought we were getting a Fed coin.
So much paranoia about that, right?
Yeah.
The government will track your coffee purchase.
Yeah, they'll turn off your money.
That kind of thing.
Yeah.
And the Genius Act it killed that idea. The U.S. decided, we're not going to build a consumer app for 300 million Americans.
Can you imagine the customer support line at the Federal Reserve?
It would be a nightmare. So instead, they gave the green light to the private sector. They said, Circle, PayPal, you build the stable coins.
How do you follow our rules?
Very strict rules. We're talking 100% backing with cash or short-term U.S. treasuries. Mandatory monthly disclosures. No funny business.
No mystery assets.
None. It basically turned them into narrow banks.
Yeah.
You give them $1, they hold $1. That's it.
And the market loved it. I'm looking at the chart. By mid-2025, the market cap hit $250 billion, $250 billion.
It's huge. It proves that once people knew the rules were safe, they were ready. But this brings us to the tension at the heart of our research stack. Panagiotis calls it the big stablecoin debate.
It's the obvious question, isn't it? If these stablecoins are backed by U.S. treasuries and treasuries are paying, say, 4.5% interest, who is keeping that money?
The issuer.
Right. So Circle or PayPal is sitting on billions of dollars of our money, earning interest on it, and paying us zero. And the question is just why? Why shouldn't you, the holder, get that interest?
From a consumer perspective, it seems like a no-brainer. But the banks and the regulators, they have a very strong contra argument. And it's not just greed, it's systemic risk.
This is where that Bank of America statistic comes in. It blew my mind.
Yeah. The CEO of Bank of America dropped this number in a hearing. He warned that up to $6 trillion could migrate from bank deposits to stablecoins if yield were allowed.
6 trillion, that's an extinction level event for community
It
banks.
is. You have to remember how a bank works. They take your deposits, they pay you peanuts, that's their cheap funding, and then they lend it out for mortgages at 6%. The spread is their profit.
So if a stablecoin comes along and says, hey, skip the bank, we'll give you the full 4.5%, nobody keeps their money in a checking account.
Why would you? And if the banks lose that funding, they have to borrow on wholesale markets, which is much more expensive.
Yeah.
Their costs go up, so they lend less.
Which means fewer mortgages, fewer small business loans, a credit crunch.
That's the steelman argument. They are terrified that a yielding stablecoin would break the traditional banking model.
But the crypto side, and frankly the consumer side, has a counter-argument. They're basically saying you're just protecting an inefficient industry.
It's the classic disruption argument. They say yield doesn't make it a deposit because the issuer isn't lending your money out. They're just parking it in treasuries. It's safer.
So preventing yield is just regulatory capture, building a moat around the banks.
And it feels like they're trying to hold back the tide. Because looking at this tokeny report, the market is already finding loopholes. We're seeing this explosion of tokenized money market funds.
The MMFs, okay, walk us through this. How is this different from a stablecoin?
Visually, on your screen, it might look similar. But legally, it's night and day. The Genius Act says a payment stablecoin can't pay interest. Fine. So the industry created a different bucket.
Okay.
You have your payment token, your digital dollar, which pays 0, but with one click, you can swap that for an investment token that represents a share in a money market fund.
So I keep, what, $500 in digital dollar for coffee, but my savings, the $10,000, I swap that into a treasury token.
Exactly. And that treasury token is a registered security. Follows all the securities laws, requires KYC, all that.
Come on.
But it's automated now. And because it's a security, it can pass the yield from the treasuries directly to you.
It's a two-step shuffle.
It is. And JP Morgan's analysis predicts this sector will just explode. They think these tokenized funds could grow from like 6% of the ecosystem to 50%.
So they're saying, okay, we won't pay interest on your checking account, but we'll make it frictionless to move into a savings account.
And that separation is key. Payments on one side, yield on the other. It keeps the regulators happy, and it keeps the users happy.
Now, to really get why regulators are so obsessed with full backing, we have to look at the ghosts of the past. We have this paper, Anatomy of a Stablecoin's Failure, the Autopsy of Terra Luna.
May 2022. I think for a lot of people that's burned into their memory. It was the Titanic moment for crypto.
But why do we still talk about it? I mean, it was 4 years ago. Surely the tech has moved on.
The tech has, but the psychology hasn't. It's the perfect lesson in what happens when you prioritize yield over stability. Terra wasn't backed by cash. It was algorithmic.
A clever bit of code.
Right. A two-coin system. And the bait was the Anchor protocol. It offered a 20% APY.
Which was just insanity back then. It was like magic money.
It was completely unsustainable. But that 20% yield attracted 75% of the entire supply. Think about that. 3/4 of the money wasn't there to buy things. It was just there to leech that yield.
It was mercenary capital.
Exactly. And when confidence broke, it was a death spiral. There was a liquidity pool attack. And because there was no intrinsic worth, no pile of cash in a vault, the algorithm couldn't cope.
So the lesson that led to the Genius Act is you can't engineer stability out of thin air. You need real collateral.
Intrinsic worth, that's the phrase. It has to be redeemable for real money, instantly.
Mm.
Otherwise, it's just a confidence game.
Speaking of confidence, that leads us to the solution in the risk mitigation model paper. This is the forward-looking part. They're proposing a hybrid monetary system.
This is my favorite part of the research.
Yeah.
Because it addresses the other big risk. We talked about Terra's algorithmic risk, but remember Silicon Valley Bank.
Right. USDC, the safe stablecoin, wobbled because its cash was stuck in a failing bank.
Exactly. Backed by cash in a bank is only as safe as the bank.
Yeah.
So this hybrid architecture proposes a solution. Private companies issue the coins, so you get all that innovation.
The cool apps and features.
But the reserves are held directly at the Federal Reserve.
Oh, wow. So it completely bypasses the commercial banks.
It does. They call it a synthetic CBDC. It eliminates liquidity risk because the money is at the Fed, and the Fed can't go bankrupt.
That sounds incredibly safe for the user, but I imagine the banks hate that idea even more than the yield one.
They despise it because it turns the stablecoin issuer into a narrow bank that just drains deposits out of their system. It sidelines them.
But the user benefit would be interoperability.
Total interoperability. Ideally, you could send USDC to a PayPal wallet instantly. The clearing becomes trivial because it's all on the Fed's ledger.
Okay, so we have the rules, we have the safety models. Now let's talk about what this looks like when the rubber meets the road. Because companies like Visa have been busy actually building things.
This is the plumbing aspect, and this is where boring gets exciting. Visa made a deal with BVNK to use stablecoins for settlement.
And to be clear, this isn't about buying crypto. This is invisible stuff.
Totally invisible. This is for Visa Direct, for global payouts, gig workers, insurance claims, that sort of thing. By using stablecoins on the back end, they can move money 200/7.
Because money usually sleeps on weekends.
SWIFT closes. Fedwire closes. The blockchain doesn't. So the user just knows they got paid on a Sunday, instantly. They don't know crypto was involved.
It just makes money move faster. But there's another application in our sources that feels even more futuristic. This Google agentic play.
This connects stablecoins to the other massive trend of 2026, AI. Google launched this Universal Commerce Protocol, or UCP.
Okay, break this down. What problem are they solving?
Think about your AI assistant. You want it to buy a specific pair of sneakers for you. The AI can find the product, but buying it is hard.
Because every website has a different checkout flow.
Exactly. One wants your CVV, another wants a CAPTCHA. It's a mess for a bot. The UCP is an attempt to create a standard language for buying things.
And the connection to stablecoins is?
Programmable money. An automated agent needs an automated payment layer. You can't have the AI typing in credit card numbers. With a stablecoin, you can write a smart contract that says, if the UCP confirms the item is in stock, under $200, execute payment.
So my AI agent uses a stablecoin to buy my groceries, and I don't even see it happen.
That's the vision. It's machine-to-machine commerce. And stablecoins are the native currency of machines.
That is wild. Now, before we wrap, we have to talk about the shakeup in traditional finance. We just got news about the Apple Card 2.0 deal.
A massive shift. Apple finally dropped Goldman Sachs and moved their $20 billion portfolio to JP Morgan.
We saw this coming, but the details are telling. Goldman was desperate to get out, weren't they?
They were. Goldman Sachs is an investment bank. They tried to get into consumer banking, but they struggled with the subprime mix of customers on the Apple Card.
People who don't pay their bills.
Or people with thin credit files. Goldman lost a ton of money on it. They just didn't have the data or the infrastructure.
But JP Morgan thinks they can succeed.
Scale. JP Morgan is a fortress. They're booking a $2.2 billion loss up front just to take this on because they know that long-term, having Apple's user base is worth it.
And MasterCard had to pay to stay on.
A $100 million incentive just to keep the network rails. It highlights this theme of specialization. You have global payments taking merchants, FIS taking banks, JPM taking consumer credit.
And tech companies like Apple owning the user experience, everyone is staying in their lane.
But the lanes are getting super efficient. And this brings it full circle. In a world of hyper-specialization, you need a universal way to move value between them. That's the stablecoin. It's the oil in the engine.
So let's synthesize. We've come a long way from the disasters of Terra in 2022. We now have the Genius Act, SEC guidelines, and a market that is, well, it's regulated and operating at an industrial scale.
And that boredom is the ultimate sign of maturity. Stablecoins are now the piping for Visa and the fuel for AI. It's not about crypto bros anymore.
But for you, the listener, the so what is pretty nuanced.
It is. It means you probably won't get rich holding a digital dollar. The regulations have put a hard stop on that to protect the banks.
To protect their funding model.
Correct. So you'll probably have a split wallet. Your checking account will be a non-yielding stablecoin for instant payments, maybe managed by your AI. And your savings will be in these tokenized money market funds, earning yield.
Payment versus investment.
Which, ironically, is just like the traditional banking world, but upgraded for the internet age. We reinvented the bank, but we made it faster and programmable.
But here's a thought to leave you with. We saw the Reddit sentiment, and the frustration is real. If banks are paying, say, 4% on savings, but these tokenized funds can offer a bit more, regulation is currently building a wall between you and that efficiency.
The protection is also a barrier.
So the question is, how long until you demand access to the real risk-free rate of the internet? And if this hybrid model takes off where we hold money at the Fed via stablecoin issuers, will we eventually look at commercial banks and ask, wait, why do we need you again?
That is the trillion-dollar question, isn't it? If the tech makes the middleman obsolete, can regulation save him forever? History suggests the tech usually wins.
Something to mull over. Thanks for listening to the deep dive. We'll catch you on the next one.